This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Brooke, thank you for joining me today. Super excited to chat with you. All right, Brooke, you are the founding managing partner of Hut Capital. It's one of the oldest crypto fund of funds in the world, I believe. And you guys launched around July 2018. You've invested now in over 25 crypto funds. You have multiple direct and co-investments. You have this awesome podcast that's all around crypto investing called Inside the Hut. And you have an extensive background in TradFi. Can you tell me, how did you initially start getting interested in crypto? Because you do have a very extensive background in TradFi. And so what was that turning point for you where you're like, hey, I love finance. I love kind of, investing, whatnot. But this crypto thing keeps popping up. I want to spend my full time and attention here.
Yeah, so there's probably, I'd say like three main things in that journey. So I graduated from college in 2008. I started my first job out of school. I was working for a family office consultant. So, worked on the finance side, focused on investing, like helping these families to invest in private funds of various sorts. But I started that job 3 weeks before Lehman crashed in 2008. So pretty much my, welcome to professional life was watching the financial world, kind of fall apart all around us. And, you're kind of seeing how fragile it was. And, starting my career like that, I think it made me, a little jaded on our current financial system. And obviously, crypto didn't really exist back then to then, do anything about that from that perspective. But, I think that's probably the first thing. So fast forward a few years, I started working in venture full time in 2014, working for a large traditional venture fund of funds platform. And, I had gone to school back in the day, in college with a couple guys who ended up being, pretty early prominent folks in the space, are still, very active in the crypto world. And, one of the managers that we worked with, my prior firm, had invested in one of their companies. And it's like, all right, well, I do venture for a living. We should catch up and I should see what this whole Bitcoin thing is. And so caught up and, he kind of ran me through like, why is Bitcoin interesting? And, here's why you should care, basically. And it was really the first time it really clicked. And I found it really interesting and fascinating. And I remember sending out a note to the kind of the full investment team at the time and, like, hey, this is really cool. We should track this. And I mean, no response, of course, because it was like late 2014. And there wasn't much for me to do professionally with it at that point. But fast forward, working for a large fund of funds platform before this, in 2017, that really changed. And, you had the ICO boom back then. It was really the first time also that you started seeing a lot of like proper capital formation in the venture space within crypto. So, I mean, there were firms that were around before that, like Pantera and Blockchain Capital being obvious examples. But, before then, they were very small. There were very few of them. And that was the first time you really saw a lot of funds coming into existence. And they actually had like real amounts of capital, including institutional capital for really the first time. So that kind of gave me the excuse with my day job to actually go out, get to know all the managers, just spend a lot of time building out my network in the space and just learning in much more depth about, kind of what was happening. And just became completely convinced through that, crypto was the future. For me as a finance investments guy, the idea of building a new financial system from scratch that is, much more open and transparent and superior to what we have today was very compelling. So eventually I just couldn't convince myself to do anything except that with the rest of my career. Is this, it's just eating at me like, all right, like financially, intellectually, just way more interesting in every way. So, back then, worked with my prior firm to make one investment in the space, but, what wasn't a focus for them back then. So like, all right, well, if I want to go do this, like, how am I going to do this full time? To the introduction, like there weren't really other fund of funds back then. So it's not like, oh, I'll go get a job at the crypto fund of funds because that's the natural place to do it. Eventually decided had to go, start my own firm to affect that. But that's kind of like, the quick background to how I got to doing this.
Very cool. So, you could argue that you were, so early, 2018, that's incredible. So at that stage, you could have probably launched your own just direct fund, whether it be venture, liquid, whatever. What made you? Obviously, you have extensive background in fund of funds, but what was that decision like? Was it easy? Like, okay, well, of course, I'm going to do a crypto fund of funds. That's what I know. Or were you thinking, hey, maybe I'll do a direct fund?
I did think about it. And yeah, so back then there were maybe, I don't know, 50 crypto VCs. There's over 300 today for context. So, it's a much smaller world. There weren't any fund of funds that looked like us back then. So I did give it some thought, but at the end of the day, like my background really was in, fund of funds, secondaries, more growth stage direct investing. I didn't have really a background in doing like really early stage investing. So I was like, all right, well, we could go out there, we could be crypto VC fund number 50 and I don't know, maybe be an average early stage venture fund, or, we can build this fund of funds platform and, I believed be the best at what we were doing. And, that just seemed much more compelling to me to have an opportunity to be the best at what we did versus maybe being an average fund at what we did. And obviously, yeah, it was more consistent with my background, have a lot of experience, doing this in my prior life. So it was a more natural fit from that perspective as well. But yeah, I did think it over, but I wouldn't say for a particularly long time.
That makes sense. All right, so in the early days, how was the fundraising back then? Because I mean, crypto is pretty new for the vast majority of LPs, and like who were these types of folks that were obviously your background is very attractive. So it's like, okay, cool. I don't really get crypto. I want exposure. Oh, this guy has a fund of funds background. He's a great person to bet on. But I mean, who were those LPs? Were they high net worth individuals? Were they crypto folks? Were they TradFi people? Like, what did that look like?
Yeah, so when we got started, it was really in the midst of the 2018 and subsequent bear market. So raising for a first time fund of funds in a space like this was brutal, if I'm being particularly honest. When I left my prior firm, it's not like we had all these LPs lined up, and it's like, oh, you're going to lead, and you have these LPs ready to go, right? It was starting from completely from scratch. Go out, build the network, build LP relationships, and that was a very humbling experience. So that is about how the environment was. I think a lot of managers who we've seen raising their first time funds through the FTX collapse and the most recent bear market, probably that will resonate with. But our LP base, and our when we're raising our first fund, it was very much individuals and family offices, who wanted exposure to the space. Felt like the fund of funds model was best suited for them for various reasons. But yeah, as a small first time fund, raising institutional capital back then would have been very difficult. So it was much more individuals and family offices. And, so I live in Oregon. Obviously we had, relationships from my past life, folks out here in the Pacific Northwest where I think definitely when you're a first time fund, folks who are kind of geographically closer to you, help with that conversation. Maybe it's different in New York because there are so many people who are local. Obviously, if you're out here in the Northwest, there's very few local firms in crypto, period. So kind of that local angle helped with various conversations as well. But yeah, very much individual and kind of family office oriented for the first fund.
Were you having to do a lot of education with those early LPs? Was it like, hey guys, here's why this is exciting. This is why you should be interested. Or was it these people already knew about crypto, were already excited and just wanted someone to professionally manage that exposure?
Yeah, there was a lot of education back then. You think about like context of now versus then, now we have, stable coins that, was a couple hundred billion of supply, trillions of annual volume. You have, applications. I think, I don't know the exact data right now, but there's close to 100 applications that are doing $1 million of monthly revenue. So that's like 12 million annualized. So you have, obviously I could keep going, but you have like a real ecosystem with real revenue, that has achieved actual scale. You have scalable blockchains. You have, a lot of activity at the application layer. Back then, like pretty much none of that existed. DeFi basically existed conceptually. Stable coins barely existed. Solana didn't exist. All of this was very much like theoretical things that will exist in the future. So yeah, a lot of the time was spent educating, like, what is this going to look like? What's the opportunity set? Why should you care about this at all? Why isn't this going to disappear? Like back then, people legitimately had concerns. Is crypto going to exist in the future, period, right? So yeah, we had to do a lot of education, a lot of explaining why we were excited about it, why we thought it made sense. Certain conversations, even like just fundamentally, like, how do blockchains work, right? And I remember I had one meeting where I was literally like up on a whiteboard trying to show like how a blockchain actually works and how transactions work and how you have like individual blocks, that fill different transactions and how that actually worked from like kind of a more, architectural perspective. These days, yeah, there's a lot less of that. There's still a lot of education and understanding like what are the different use cases and things like that. But, relative to back then, you don't have to convince people as much that crypto is a real thing. Like, it's pretty clearly here to stay at this point. Obviously, the regulatory environment now, helps with that as well in terms of what we're looking at going forwards in terms of providing legitimacy. But yeah, there was a lot of education back then, and we still do a lot of education, but it's less of the work than it used to be, which is nice in a lot of ways.
Yeah, it's also funny you mentioned about like, people having thoughts around like, is this going to exist? Because I remember 2018. So I feel like everyone's first crypto cycle, when they experience that first bear market, and maybe the cycles will stop in the future, but when they experience that first bear market, they kind of have that thought process of, oh my gosh, is this going to like disappear? I first got involved in 2013, 2014. I was like, it's over. Like, I was like, Bitcoin's finished. Like, this doesn't make sense. Oh my gosh, it's all finished. And then 2017, obviously great market. 2018, bear market again. I was of the mind, okay, this is not over at all. Sure, it's going to be difficult and it's going to be hard and whatnot, but it's a kind of a very different environment. But I'm sure people coming in this current cycle, or maybe last year or whatever, they're probably having kind of same thoughts of, oh my gosh, great year. Potentially next year is going to be bad. Who knows? And maybe they'll have the same thoughts of, wait, hopefully this maintains to be a viable market.
Yeah, we saw with the FTX collapse, and you definitely had questions around that back then. And I think that's one of the advantages of being in this space full time. Is like, if you actually have conviction around this space, you can see those as opportunities instead of problems. Where it's like, all right, well, the rest of the world saying, hey, is this going to exist? We have conviction that it's going to, and you can use that, to your advantage versus, kind of as an issue per se. Easier said than done, of course, but it's bear markets are almost nice from that perspective these days. So
absolutely, yeah. I mean, it's so far, knock on wood, proven to be true that every time that there's some calamity and people are kind of panicking, that if you stay convicted and you kind of double down, then you are very successful after the fact. So
yeah, tends to work out well.
All right. So these early managers, again, this is the very early days of this ecosystem forming. So would you, go on Twitter and ping these folks, or like, how would you reach these early managers?
Yeah, sometimes we just reach out cold. I definitely reached out to people over Twitter. Introductions from other friends in the industry, or just kind of asking, hey, who knows this person? But I mean, back then it was pretty easy because, thinking back to when I started doing this at my prior firm and reaching out to everybody, there weren't that many funds out there. They were all pretty young. I was working at a big firm that had a lot of capital. So frankly, people were very, very willing to speak with me because, when you represent a large pool of capital and you're a emerging fund, that's typically a welcome conversation, right? So it was pretty easy to get in the door from that perspective and, kind of start having those conversations. And then, even once I launched at Capital and kind of went off to do it on my own, still frankly the same. It was very easy to access people just because, you're working through a bear market. It's still a young industry. That part of it wasn't very difficult, but yeah, I mean, it was pretty easy to get in touch with people through Twitter, just reach out cold, finding kind of warm intros from friends in the industry. We would even just and to this day, we'll reach out to people cold where we see some deal announcement, something we think is pretty interesting. We see some fund listed there. We have no idea who they are. It's like, oh, I don't know who this group is, but we should reach out and see what they're up to, right? And maybe or maybe not, it's interesting for us. But yeah, we're pretty proactive from that perspective.
Very cool. Okay, so again, in these early days when you're making the first initial fund-to-fund investments, how would you go about deciding who to back, and also what type of strategies? Were you looking at more hedge fund style or trading style or venture, or what strategies, and also what managers kind of convinced you that, okay, this guy or girl knows way more than most. I want to back them.
Yeah. So back then when we were getting started, very, very, very different than it is today. So back then, everyone was a generalist, right? So you were a crypto fund, and that was niche enough in itself, right? Maybe there were, but generally speaking, there weren't funds that were, particularly narrow within crypto. You're just a crypto fund. Likewise, frankly, the quality back then was not nearly as high overall as it is today, from a manager quality perspective. So that back then the question is can I actually find enough managers to fill a fund to funds that meet our bar? And that was really the question. Most of these were first time funds, right? Again, you had some that had been doing it for a while. But most of them were pretty new to doing this, hadn't been, doing it for very long. So you're just trying to work through, okay, who has a good brand, who has a good idea around how to deploy in the space in terms of, their ability to access top founders, running an institutional level shop that we can be comfortable with, from an investment process perspective, from an operational perspective, and kind of going through some pretty basic diligence that narrowed things down pretty quickly to a relatively small number of funds. The vast majority of which are all kind of much larger, pretty well-known funds today. But yeah, diligence was a lot more simple back then because there weren't that many options. And it's a question of kind of, all right, who's institutional and who does a really good job in this space to, provide us with good exposure. There's obviously more nuanced things around what's the right approach and, how do we build a portfolio and things like that. But yeah, it was much simpler days. And I guess for context, we can go into more of it, more into the sits of interest, but you have, way more funds now. It's much more competitive. You have a lot more specialization. So you have funds that are very specifically focused just on individual verticals within crypto, individual subsectors, individual ecosystems like blockchain ecosystems, geographies, right? So, over time, you've seen more and more specialization as new funds. Okay, well, there's all these generalist funds out there. How do I build a differentiated firm and differentiated brand? And one way to do that, of course, is through, specialization. And, we see a lot more of that today. But back then, everyone was a generalist. It was a very different world.
Yeah. So when you're looking at the ecosystem or the market today, what are the different categories or buckets that you're able to place these different funds into? Because you just said multiple. You're geography. There's different strategies. There's different ecosystems. And could you kind of give me the broad view of your breakdown of this is venture, this is liquid, this is blah blah blah, and then you have these? Could you describe that? Yeah.
So there's probably two ways to answer that. I'll answer it both ways to the question. One would be what you referred to at the end, which is kind of fund structures. So if I had to break down what are the categories, there are closed-end venture funds, there are liquid funds, totally open-ended funds, and there are kind of these hybrid funds that in practice are open-ended but have maybe certain longer redemption periods, or you are locked up for some period of time, but then thereafter it's open-ended and you can redeem your capital. So it's kind of has a little of both. We are solely focused on the closed-end side of things. So that is where we focus. We don't invest in liquid funds. We're not honestly a huge fan of hybrid funds. The short reason why is a couple key things. One is around alignment. where a lot of those funds, and again, not all of them, but historically have taken carry every year. And if you're doing long-term venture investing, you really shouldn't be taking carry until your LPs are getting their capital back. It's just the right way to have alignment between LPs and GPs. So we've seen a lot of structures around that we're not really big fans of. Likewise, we've seen some situations where, firm management fees are tied to AUM. You're in a very volatile space that goes up and down, and suddenly you're kind of like in a tough operational position. We've seen that happen in the past as well. But just fundamentally, like if you're doing early stage venture, we believe it's best done through a closed-end structure, where you're locked up, you make decisions, you get your capital back as there are exits. And, there's also a lot more operational complexity and other things we get into. But so we are solely focused on the closed-end venture side of things. Maybe one nuance I'll add there is like a lot of closed-end venture funds do have buckets to invest in liquid assets, and we are fine with that. Like I think, especially if you're in a bear market, you should have that opportunity as a closed-end fund to take advantage of market dislocation in this category. Maybe that's different in traditional venture, but in crypto, that is clearly the case. So we're not against that. We just think it's best done through a closed-end structure where if you want to do that liquid stuff, you can do it when there is dislocation and you're not kind of forced to take permanent market exposure. We think it's better done in that manner. But fundamentally too, like we are focused on early stage venture. So we're like the hedge fund side, like we wouldn't invest in a quant fund. It's not a fit for what we're doing. It's not in our mandate, right? So it's not that we have any problem with open-ended funds or hedge funds. It's just not what we do, given our focus is on early stage venture. The second part of that is kind of like categorically, like how we break down funds within the venture ecosystem. Off the top of my head, I'd probably break it down to like 4 categories. So there are, let's just say, generalist funds. So they kind of we'll look at anything. And in those cases, you're really just betting on the firm to really have their pulse on the industry. Maybe the individual GPs are just incredibly talented, but you're kind of betting on them to navigate the industry as it unfolds over time and make really good decisions and attract really good founders across different categories. 2 would be kind of subsector specific funds. So these would be funds that are focused on, let's just say, just to use different categories, like just do gaming, just do infrastructure, just do NFTs, just do DeFi. It could be anything, right? Where, okay, well, why would you want to do that? You would want to do that, for a couple of reasons. One, to get more exposure to a category that you think is particularly compelling. And then 2 would be because you think, that firm that has dedicated focus on that category will just provide superior exposure to generalists who are trying to cover that, but also trying to cover 10 different things, right? So, if you just do DeFi all day, you're probably going to have a deeper understanding of the market than someone who's trying to cover a broad range of categories, just naturally. It's just, a result of focus. So we have invested in funds like that. I think, in certain situations that makes a ton of sense. So we have done some of those as well. The third category would be, I guess blockchain specific or more ecosystem specific. We have done a couple of these, but historically we haven't done a lot. Largely, we've seen like over time a lot of these like ecosystem focused funds, and frankly, it feels more more of like a biz dev effort for the ecosystem than like, hey, how can we maximize making a ton of money for LPs? So we generally haven't been a fan of those historically. That said, probably the last couple of years that's changed. We've seen funds that are largely focused on certain ecosystems, but like these individual ecosystems are now big enough where they can support dedicated funds that are solely focused on maximizing returns, and like, that's all they do. And, I do think there are certain instances where that makes sense. So, just to give a couple examples, we're LPs with Frictionless, which is, focused on high throughput ecosystems, does a lot in the Solana ecosystem. We made a very concerted effort there. It's like, all right, let's go out to the Solana ecosystem back in 23, figure out, who are the VCs that are most active here, who do founders want to work with. And, there's a very concerted effort where we wanted to get more exposure to the Solana ecosystem. We haven't announced it yet. We're also, we've also invested in a fund solely focused on the Bitcoin ecosystem. And yeah, that's another one where we do have exposure to the Bitcoin ecosystem, but we think it makes sense in that instance, one, to have more exposure to the ecosystem, two, to work with a dedicated fund that just does that day in, day out, really deeply understands the ecosystem, sees everything out there. And I can't say who that one is because they haven't announced their fund yet. But we have done a couple more ecosystem specific ones over the past kind of year and a half. The fourth category would be like geographically. So in crypto, a lot of funds are pretty global, invest everywhere, but there are funds that are, more regionally focused, like maybe just the US or heavily focused on the US. And, maybe you have funds that do a lot in the Bay Area, a lot in New York, or a lot elsewhere. You have funds in Europe, Asia, I mean, pretty much every geography at this point. So, we do think about it from that perspective as well. Is there a great fund in Europe that we want to work with? Is there a great fund in Asia that we want to work with, or whatever it might be? So that's kind of one other way that we think about breaking up the portfolio and kind of how different funds position themselves. Sorry, that was kind of like a pretty long answer.
No, that was amazing. that I love that. Thank you. Okay, so out of those different categories and subcategories, have you noticed correlates of success where, okay, actually, it turns out that all of our managers, that are in the States are tend to outperform, or okay, it turns out that all the managers that are like this tend to outperform. Have you noticed any correlates, or is it variable based on markets, timing, and cycles, or how have you seen that?
Yeah, so I wouldn't say we've seen a huge correlation overall in terms of like generalist outperforming sector specific or vice versa, or regionally specific outperforming non-regionally specific funds overall. So I'd say to a large degree, like the jury is still out. It's really until probably 3 or 4 years ago. I mean, there weren't a lot of dedicated funds in underlying sectors. Like a lot of these funds are less than 4 years, maybe even just like 1 or 2 years old. So, I mean, to be honest, like a lot of that data is too early to say and will play out over time. So yeah, we haven't seen any strong correlation there. Yeah, I'd say from a timing perspective, we definitely see that some vintages have outperformed others. It's kind of generally what you would expect. I'd say overall bear market vintages outperform bull market vintages, generally speaking. But there's also exceptions to that. There's great deals that get done in the bull market where, you have some startup and, it becomes a huge winner for whoever backed it early. And yeah, the deal got done at a very, like maybe at the height of the market, but, they came in at a pre-seed level. It ended up doing really well. And those funds have really outperformed despite being, maybe bull market funds from a vintage year perspective. Likewise, you have funds that raise in a bear market and do poorly. So yeah, there is some, if you look at the overall data, definitely some vintages outperform others, but it's not a categorical thing. You still see bad funds that start in bear market. You still see great funds that start in a bull market. But yeah, a lot of that data, frankly, is too early to tell. One thing that we do focus on a lot, though, that we do have data on is fund size. We believe very strongly that smaller funds outperform. There's a lot of data out there in traditional venture that shows smaller funds outperform. And we see the same thing in this space. And, if you look into our portfolios, our smaller funds have outperformed our bigger funds. First-time funds have outperformed non-first-time funds. Obviously, the two are related, but not the exact same. It could be a fund 10, as long as it's small, it'll be in the smaller fund bucket. So we do see that smaller funds outperform. That guides us a lot in terms of how we operate. So we actually are, as a firm, specifically focused on backing smaller funds. And there's not an exact number where it's like, oh, you're over X. So, that's not in our mandate or whatever. But, generally speaking, that is a big focus for us. And it is pretty clear that smaller funds outperform. And yeah, I think if people look at some like the really outsized returns that some of the early crypto funds achieved, they were early, they got into some really big thing early on. But I think the other piece of it that people forget about is they were also really, really small. Like some of those early funds that had like just crazy, crazy returns, they were 10, 15, $20 million.
Totally.
And, if they had been 10 times that size, they still would have done well. but they wouldn't have done nearly as well as they did because that small fund size allowed them, when they had that huge home run, to really head of the park versus doing well, and still, their LPs are going to be happy, but that's really how you get the outsized returns, is by, keeping your fund size more reasonable.
No, I think that, TradFi shows that, TradFi venture and, crypto venture, I would assume would be the same. So that makes sense. Is there a fund size sweet spot that you are most like? Is it, 30 million, 50 million, 100 million? Like, what is that? You're like, oh, I love this number, just broadly speaking.
Not precisely in that manner, but so if you look into our fund two, just for context, the median fund that we've backed is 50 million in terms of who we've supported, as a fund of funds in our second fund. So there's not an exact number to answer your question, but at least that data point gives some context in terms of like what have we actually done, and kind of where we've supported funds from a fund size perspective as the median.
So the smaller fund sizes tend to outperform the larger funds. Is there a data point behind that? Meaning, like, okay, the smaller funds are 2x better or 5x better, or is it a small difference, or is it a very notable difference?
I guess without giving exact numbers, the data that we have shows a pretty material difference. Of course, a lot of that data still is with funds that are generally still they're not at full maturity, right? So those numbers will change over time, and obviously that's the end result that we care about, is in a few years, once those funds have actually reached the maturity, what does that data look like? But yeah, definitely if you look at the interim data, smaller funds have, let's just say, materially outperformed larger funds, in terms of our data set.
Awesome. All right. So how would you define Hut Capital's investment philosophy? Like, is there like a broad, kind of definition there of, hey, this is what we do, this is what we believe in? Or is it because, crypto's so new and ever changing? So is it difficult to say, hey, we do X?
Yeah. So I guess depending on how you think about it, there's two answers to that. So there's kind of like our general approach, right? So we, our thesis, or like kind of our model is a fund of funds platform. So as a fund of funds, we're backing these smaller early stage closed-end venture funds. We'll build a portfolio, of who we believe are the top, funds within our criteria and based on what we're looking for within managers. And, so that's like the first leg of the stool. The other two legs of the stool that kind of represent the platform piece of fund of funds platform are the secondary and direct side. So, because we run a fund of funds, we're an LP with these various funds. We have a lot of look through to what they're investing in, a lot of, insight into how the underlying companies and protocols are doing. That gives us a lot of intel that we can use in other ways. The first piece is secondaries. So we've been a pretty active buyer of fund secondaries in particular the past couple of years, but remain a very active buyer in that world. I actually used to work for a secondary fund, so I have a long history of doing that for a living, and we've just kind of ported that over to the blockchain space. And for folks who might not be familiar with that, basically how that works is, you're an LP in a crypto VC fund or any closed-end fund. If you need, you need out, there's no redemption mechanism, right? So the only way to get liquidity is to sell your interest to a buyer, at some negotiated price that you agree on. So, obviously having the fund of funds platform, knowledge of how these funds are doing, the GP relationships, all those are very helpful in executing on the secondary side. And then the other piece is on the direct side, where same thing. We have look through to all these different portfolio investments. We're coming in typically Series A and later, so I kind of joke, we let our managers do the hard part, finding the best founders at the pre-seed and seed level, and then we'll track the portfolios, find things that we're excited about, and then come in more Series A and later. So once there's kind of like real traction and revenue, it's more about scaling than finding product market fit. So that's kind of like our general approach, like as a fund of funds platform. So obviously the fund of funds is the core, but the secondary and direct side of what we do are also very important pieces of it. So that's kind of one answer to your question. The other answer, is just like the thesis. And, we're, because we are really broadly focused across the ecosystem, we're not trying to, say, hey, I don't know, we think DeFi is great. We're going to go give exposure to lots of DeFi. Really our goal is to go out, find the best 20 managers in the ecosystem and, support them, let them go out, find the best founders in these different ecosystems and different categories and, help us to build a world-class portfolio, through that fund of funds model. But it's such like a fast moving space. New categories pop up very quickly. Narratives change. Like, I think trying to like chase narratives or get too cute around that type of thing is kind of dangerous. Our goal is really to provide diversified exposure to the top startups, very broadly and in a diversified manner across the industry, really across all categories, all blockchains, all geographies. And, through a single relationship and single investment for our own investors. So, we think that value proposition makes a lot of sense. Having a specialist where, they can go out, know the ecosystem, know the managers and help help certain investors to navigate that through a fund of funds model.
Portfolio construction. How would you, if you could design the optimal portfolio, and obviously you do that, but at the same time, it's like, in a perfect world, like I want all my fund managers to be in New York City and, like this, like how I want every fund to be 30 million, like, and only 10 funds or whatever, like in our new fund, whatever. What is like the perfect portfolio construction if you could wave a magic wand and just like design that?
So we back about 20 funds in each of our vehicles. That technically includes the secondaries. I'd say in terms of like the fund side of it, there's not really any targets around that. Like we find that our answer to that at any one point in time tends to change. So, I had mentioned, for example, we recently invested in like a Bitcoin ecosystem fund. If you had asked us 2 years ago, are you going to do that? I would have been like, no. And like, not that we weren't open to it, but we just hadn't seen anything that justified doing so. Our view on that has since changed. And so, we, as I mentioned, decided to make a more ecosystem specific bet there. But I think you just kind of have to be open-minded and kind of go with the market. And, if the market's telling you, hey, here's a really interesting new category and there are new funds popping up here, you go through and talk to those managers, try to understand the category better, understand your existing exposure through other managers and see if that makes sense. And TBD on whether that's going to, depending on any certain category, but there's not really any like preset portfolio construction aside from wanting to be broadly diversified across the ecosystem, being very globally focused. So, definitely from a geographic perspective, we love working with managers outside the US. Historically, that's been largely Europe and Asia. There are managers, outside of US, Europe, and Asia. But if you look at kind of like the, let's say like the crypto VC data, the vast majority are in those three ecosystems. Those are kind of like the three largest. Probably the other thing I'd mention is it's not a preconceived notion, but we'll go through every quarter within our portfolios, and we'll actually map out like every single line item that we have exposure to, and we can say, okay, well, here's how much exposure we have to different subsectors, or here's like the equity token breakdown, right? And as our portfolios are playing out, we can look at this like, oh, well, here's kind of like a gap in our portfolio, or here's something that we're underexposed to. Maybe we should look at ways to change that. And that may or may not lead to anything, but we're kind of constantly doing that kind of real-time assessment to determine if we feel like our portfolio balance makes sense, are the things that we're missing, and making sure we're aware of that and plugging those gaps if we see fit. On the fund size piece that you mentioned, honestly, the answer is just smaller. There's not a certain number, generally just smaller than what they are, or what they're often aiming to be is the honest answer. But yeah, it's not a specific number per se.
All right. So when you are talking to different managers and trying to do diligence and assessing their traits, are there specific qualitative traits that you're looking out for because you've noticed that okay, people that are like this are tend to outperform, or I don't know, maybe they're super in the weeds or always on Telegram and Discord and just kind of in the know, or maybe it's something more quantitative. I haven't touched on. Yeah. So what are the traits that you like to see in managers?
It's not a specific consistent thing necessarily that we're looking across our different managers like, hey, we're looking for X, Y, and Z, and you have to have this. I think the reason that different funds can be successful, vary across the ecosystem. And a lot of the groups that we back are emerging managers. They don't have long track records. Maybe they're first time funds. Obviously, if they're later, more mature, going through track record and digging through that and understanding that is very important. But, let's say in the absence of like a long track record, there's probably a couple ways. One would be, if you're more of a generalist, there's just a lot of folks out there that we just kind of see as like really unique talents. They're just incredibly sharp, very thoughtful investors, like very long-term commercially oriented investors that aren't chasing narratives, but, really trying to back great founders who have big long-term visions. Folks who have the ability to attract top founders and win deals, right? If you don't have a very clear differentiation for your capital, why are founders going to take your term sheet versus the other 5 or however many term sheets they might have? Like, either one, they really want to work with you because you're an expert in a certain category. You have certain brand cachet, you have very unique kind of value proposition in terms of how you can help post investments. There's various reasons, I guess. And even what that value proposition can be different. Like maybe it's a group who's highly technical, and that's what one startup is looking for because of what they're building. Maybe it's, that they just have like a really big brand and that, they want them because of their kind of broad reach. Like, it doesn't have to be one specific thing. It depends on kind of category that they're focused on. So yeah, those are kind of some things that, that we look at. But at the end of the day, it's like, how do you differentiate yourself as a firm versus everybody else out there? And that can be often tough for an emerging manager, which is why you do see a lot of newer funds tend to be more specialized where they can say, hey, I'm going to focus solely on this ecosystem. I know this ecosystem or the sector, whatever it might be, like extremely well. I see everything in that category and I have amazing access to, the top founders within that category who want to take my capital for, whatever the specific reasons might be. And obviously, there's still a ton of execution that happens there. And we have to get comfortable with that. And, we have to do tons and tons of references. And that's probably big. That's a big part of what we look for as well is, talking to founders that they've backed, talking to other founders in the ecosystem, talking to other GPs, talking to other just friends in the industry. And like, it's still a pretty small world, crypto. Like you can relatively quickly triangulate what a person's reputation is. And, obviously that's only one input into your diligence process, but it is a very important one, as you're trying to understand, obviously the GP is always going to tell you they have access to everything and everyone loves them and their value proposition is amazing, right? But you actually need to go out and validate that in the market and, make sure you're hearing the same thing from market participants. Probably the last thing I'll mention is just, like operational soundness. That is exceedingly important. There's a lot of potential operational risk in crypto. So, ensuring that whoever we work with is very thoughtful and very operationally sound is also super important. Obviously that's like, okay, one, we have to find a manager we like, and then we need to ensure that they're operationally sound. That's not where we start per se, but, it is a super, super important piece of the puzzle.
I want to touch on the operations shortly, but before, and you kind of mentioned this in a few different ways, but when you're talking to managers, and again, these are early stage managers, so it's difficult because a lot of them are emerging and whatnot, but how are you identifying managers with edge that you believe is sustainable?
It's a good question. So it probably depends on if they're a generalist or more of a sector specialist. If they're a sector specialist, typically, let's say you're looking at a certain ecosystem, you can literally go out and talk to every single fund pretty easily. And you can compare and contrast and figure out who really has an edge, between that and just, talking around within the ecosystem to various market participants, talk to founders that have raised capital, understand what deal dynamics have been like, and, who's actually winning deals because people want to work with them, who's out there just throwing some small check into every deal deal that happens, and that's how they're getting access. They could never win a deal. Understanding like why founders have chosen to work with these different leads, and just kind of get to the bottom of that. Obviously, you can have that conversation with the GP as well, and dig in with them. Like, okay, well, why do founders want to work with you? And that's something we ask every GP, right? Like, how do you differentiate yourself? How do you convince a founder to work with you guys? And there's a lot of funds out there, and like by definition, most of them aren't that differentiated at the end of the day. You really have to get us excited. Like, there really needs to be something unique and outstanding. Like, we hear the same story like 10 times a day, right? Oh, we do this and that. But like we're really looking for things where they really seem differentiated, unique relative to other funds, and where they've built maybe a certain brand cachet or reputation, where they truly do have like a differentiated value proposition for founders that really allows them to come in, win deals, even if they're not paying the highest price. For generalists, it's a little different because probably like if you're having to navigate the whole industry, understanding kind of where the puck is going, like which categories are really interesting and haven't emerged yet, which ecosystems are really interesting and haven't emerged yet, and like really being early to those ecosystems. That's one way that we've seen funds do really, really well, is kind of like being ahead of the market in that way. So obviously, as a first-time fund, that's tough to gauge. It's a little easier to gauge over time and seeing what they've done and have they built a track record of doing that. But yeah, for first-time funds, if you're a generalist, obviously that's harder to gauge unless you have like maybe you came from another fund, you can take that track record, or you've been an angel for a long time. There has to be some sort of like clear proof point that they can execute versus just saying that they can clearly.
Totally. All right. So operations, when obviously custody is a huge one, figuring out where these assets are going to be custody. Is it self-custody? Is it with a QC? There's a whole bunch of questions around that. In addition to custody, what are some other items that you really get into on the operational front?
Yeah, I mean, custody is obviously a big one. Like, what is the approval and transfer of funds like? Who can like set up a crypto transaction? How does like capital flow, getting on and off ramp between bank accounts and custodians, and whatever that might look like? How do you do trading operations? So if you're let's say you have a liquid token, like what do you do from a sell perspective? Maybe it's working with certain OTC desks, maybe it's working with prime brokerage. Obviously, there's different ways of going about that, but just understanding like what all of that looks like and ensuring that security is number 1, 2, and 3 priorities if you hold a lot of crypto. One of the nice things about the venture model is you don't hold assets on exchanges. So inherently there is less operational risk for a crypto VC fund than a crypto hedge fund that's doing a lot of trading. You can just hold your assets with a custodian or cold storage or whatever it is, but you're not going to hold them in exchange where we saw with FTX, right? There were lost funds because people held assets on FTX went down. So you don't have like that exchange risk like you do on the hedge fund side, which obviously is great. So it really just comes down to how they manage their funds, how capital gets moved around. Also, like, how do you just think generally about exiting assets? And it's not operational per se, but like it's a piece of the puzzle you don't have to worry about maybe in the same way in traditional venture, but it's huge in this space where if you own a bunch of liquid tokens, like what's the exit process look like? How do you make those decisions? How do you exit large token positions without crashing the market or at all if you own kind of like a material portion of the supply? So there's kind of things like that as well that that we'll dig into.
So in your experience, what have you seen as the biggest driver of a fund success? Is it like timing of the market? Is it their access? Is it, they happen to be only doing infrastructure or, some category? Is there something that you're seeing repeatedly that like, oh man, these funds that time the market, they always crush it? Or, is there something like that?
So I'd say probably the most consistent thing we've seen is, being smaller and early. So generally, if you had a relatively smaller fund and, been early to a new category where you've been able to back one or more kind of big winners that emerged, that typically ends up really, really well, because if you come in early, typically the valuations, if you're coming at like pre-seed seed level, are going to be pretty reasonable. You get a big outcome, you have a small fund size, that's typically going to lead to a very strong outcome from a multiple perspective. Yeah, it's hard to generalize, but that's kind of like an easy answer. Certainly in the bear markets, those who have been patient in bull markets and then, really aggressive in bear markets, which are easier said than done. But, those who have done that thoughtfully and well have clearly benefited from doing so, is what we've seen historically. But yeah, it's kind of hard to generalize just because, fund by fund performance varies greatly. So yeah, it really comes down to manager selection versus being able to say, hey, I'm just going to go back the 10 funds that meet this criteria of being like, oh, I don't know, sector specific and X and Y, right? It's hard to generalize for the most part in that way.
Totally. I think small and early makes total sense. If you have a small and, fund size, that's easier to return multiples on. And then also the, early to a narrative that is going to grow massively. That's just like a huge winning combination. So that makes total sense. Are you allowed to give an example, and you can be as vague as you want here, but give an example of a great investment, whether that be a fund investment or a direct? You don't have to name names if you don't want it, but just kind of a broad.
Yeah, sure. Yeah, I'll speak to one of our early investments. Just it's had longer to play out, so we can kind of more comfortably say that it's going to end up pretty well. I mean, obviously, I can't give like specific numbers or anything, since it's a fund investment and we're beholden to LPA confidentiality. But yeah, so probably one example would be we're LPs with Variant Fund since their very first fund. Yes, that was kind of one of our earliest investments back when they were kind of a first time fund backing Jesse Walden. Yeah, that was a situation where we just saw Jesse as a really unique talent, just kind of like one of those individuals that you really, really want to back whatever they're doing. Had built a great brand, had very good kind of name awareness in the space at the time. And they were early supporters of folks like, Uniswap and Phantom and WorldCoin. And we're confident that that's going to be a good outcome for us. So yeah, that's kind of one example as one of our earlier investments. There's a lot more recent examples of things, that are maybe off to a really good start or we're quite excited about. But yeah, that's kind of one specific example.
Very nice. Yeah, Uniswap, Phantom, and WorldCoin. Not too shabby. Not too shabby. It's pretty good. Cool. Can you go into a, we'll call it like a challenging situation, a crucible moment, some sort of, because, you've been around since for a while and crypto is full of crucible moments, as we know very well. Can you describe one of those moments and kind of a lesson you learned from that process?
Sure. So probably for us, I mean, the hardest thing we've ever done was raising that first fund. It took a while raising in a bear market. We actually came within like less than a month of running out of money at the opco level and basically having no plan B. It's like, we never planned to not make this successful. So if we're going to go down, we're going to go down in flames. So yeah, we came very close to running out of money back then. Because this before our first fund was up and running, we'd had the management fees, right? So we were supporting ourselves through other means. We were able to, basically come to a solution for that when we had, 2 or 3 weeks of runway left, and we were suddenly going to be in a very, very bad spot. And yeah, I mean, to some degree, we were very fortunate, to make that work out. But probably the biggest thing is just like persistence, kind of like trying to raise a first time fund through a bear market. Like, you just need to stick with it and keep going. And eventually, hopefully if you put the time in, things will work out. And, we see that ourselves, right? Especially like in the most recent bear market, we've seen a lot of funds that, have been in a similar position conceptually, right? Where it's taken them a while to raise a first time fund. So it's been a very difficult fundraising environment. And, we will watch how do they deal with that, right? How do they take that? Do they use it as motivation? Do they just grind through and, have no plan B, right? And obviously that's what we want to see is that, they have complete conviction and whatever it takes, they're going to get it done. But, that's obviously something that can often also be easier said than done. And when you're in that position, it's easy to kind of get down and like, oh man, is this ever going to happen? But, you just got to stick with it and, hopefully it will.
Yeah, I mean, it's hard to raise for crypto. And raising for crypto in a bear market in 2018, that must have been wild. So very happy that you successfully did that, of course.
Yeah, I'm not sure if that's how you meant crucible moment, but at least like
Yeah,
us as a firm, that was probably
definitely fits the category for sure.
yeah.
All right, so how do you imagine crypto as an asset class is going to evolve over the coming years? We finally have, I don't know, I say finally, yeah, well, we have hopefully good regulation coming in. We have the president launching a meme coin. We have Bitcoin breaking 100K. So how do you expect the asset class to evolve over the next, we'll call it like 4 years?
Yeah, I mean, I'm pretty excited about what that means for the industry. So what I care about is fostering a strong atmosphere for innovation here in the U.S. So, if the president wants to launch a meme coin, I guess that's up to him. I mean, I don't care about that per se. If we have a Bitcoin strategic reserve, I don't know. I have mixed feelings about that, to be honest. Like, does that support innovation? Maybe indirectly. Do you want the U.S. government owning a lot of Bitcoin? If the government's not as friendly in the future, I don't know. So what I care about is clear legislation, or sorry, clear regulation. Through legislation for how do you operate in the U.S. if you work in crypto, if you launch a token, if you do various activities in the space in a compliant way, where people no longer have to be afraid about frivolous lawsuits and spending half their budget on legal, and it's like clear rules, right? Okay, you want to launch a token, you want to operate in this industry, here's how you do it, and people can act accordingly. I think if we see that, startup activity here in the U.S. will flourish. I mean, even just the idea of that, we see already, the U.S. becoming a more attractive destination, even though technically that legislation does not exist yet. So we've already kind of seen the anticipation of that start to take place. I think we'll see more, less people leave the U.S., more non-U.S. founders come here, more startup activity here as, the legal risk and the personal risk lessons, for startup founders in crypto in the US. I think we'll just see more people take that leap and move into crypto and, start new company and protocols here. So all that's really exciting. I also think the regulatory clarity will allow large companies to come into this space in a big way, in terms of new market participants. So these are big financial services companies, tech companies, other types of companies that are going to be customers for these startups that haven't been there before. They're going to be acquirers of startups. They're going to launch their own products, right? And, bring their own products to market. And, as a lot of folks know, there are a lot of these big companies that have basically built out offerings already or have teams ready to go. And it's like, they're just waiting to hit the start button once they have, appropriate regulatory clarity. So, from a venture perspective, that means more startup activity, more high quality founders, starting, companies and protocols here in the U.S., more M&A activity as big companies look to play catch up, which I think, we'll start to see the exit side, pick up in the coming years. Hopefully we'll also see a crypto IPO activity return in the U.S., which will be wonderful for, for all involved. Obviously, for venture investors to get liquidity. A lot of that liquidity, typically tends up getting recycled to the ecosystem, right? You have all these people who now have like liquid wealth instead of paper wealth. They go start their own businesses. They angel into new companies. Like this very, positive circular loop that exists. So I'm pretty excited. We obviously also have pretty pro crypto agency heads across different, kind of key financial regulatory agencies now as well, which we expect her to foster a much more thoughtful approach to enforcement here in the U.S. And, again, I got kind of I guess moving away from regulation by enforcement, which has been a pretty clear failure here in the U.S. So, yeah, I'm pretty excited. I think it's going to be a wonderful 4 years for startups in the U.S.
And again, you can be as vague as you want here, but have you seen the fundraising environment change or shift since since the election results? Like, because obviously the last administration was not very, pretty anti-crypto, obviously. So have you seen a shift in terms of your own business or in terms of other people that you talk to?
Yeah, so I mean, obviously we have, we talk to GPs all day, and they're out raising money, and we talk to them about how it's going and all that kind of stuff. So we have pretty good viewpoints in terms of how this kind of stuff impacts those conversations. And yeah, we talked to a lot of folks as well, where it's like, talking to LPs around the space, where it's like, hey, we're basically waiting until the election because they want to see what happens with the election, right? And it's hard to know what their perspective would have been if Trump had not won. But definitely given that Trump did win and is a far more supportive administration to the industry than what we would have expected otherwise. We have seen people re-engage, with different managers, and it takes time. Like, if you're out there raising institutional capital, like, let's say the election happens, the positive outcome happens for the industry. It doesn't just like instantly turn into tons of dollars flowing in. For a lot of folks that restarts we should pay attention to crypto again. Okay, now we need to map out the markets. We need to re-educate our board, right? So there's like a potentially material lag from that positive event happening to actual like capital flowing into the space. But yeah, I mean, talking to different funds, it is pretty clear that things have picked up to some degree, but it's not, if you go back to like 21, 22, you had people just throwing money hand over fist to venture funds. It's nothing like that, to be clear. But we have seen things slowly pick up again. And, I would generally expect this to be, a good year and clearly better than last year for, venture capital fundraising.
All right. So looking forward, 5, 10, 20 years, where do you want to take Hut Capital?
I mean, the honest answer is we don't want to be massive. Like, we don't want to, be a huge, massive firm with billions and billions that we're managing. Like, and like, I just, same as we look for in funds, I think scale is the enemy of returns. That guides how we operate as well. So, certainly we have ambitions to grow our firm. But I mean, to be honest, like, all I care about is making sure we're best positioned to execute for our LPs, whatever that looks like. Like, it's not going to be having the biggest AUM or, that's not our goal. The goal is like, how do we best position to execute ourselves continually for the long term? The platform approach that we have, kind of fund to fund, secondaries, direct. So I would definitely see the secondary and direct side of things, having a growing influence over time, naturally, as we build a platform as well. But to be honest, we'll grow the firm, we'll continue to hire, you'll definitely build out the team, which we're excited for. But we just want to do the same thing for a long time, hopefully do really, really, really well for our LPs. And I love doing this for a living. Like, I love my job. If I had to wake up one day and I was like spending all my time managing a big team, instead of kind of doing a lot of the day-to-day stuff I love, I'm not sure I would like that very much, to be totally honest. So, both from a personal perspective and from a how do we best execute for our LPs perspective, I think we stay lean. We continue to have this focus on smaller funds and then build out the platform side of things to, increase those capabilities over time.
Amazing. Brooke, are you ready for the rapid fire closing questions?
I have no idea, but let's do it anyways.
All right. What is the best piece of investment advice you've ever received?
Oh, that's a good question. It's the best piece of investment advice I've ever received. I'm not sure it was maybe directly per se, but definitely one of the things, I've learned and kind of seen put in practice is like, you don't need to win every deal. You don't need to do every deal. Like, you need to stay disciplined. And yeah, that means there's some stuff that, isn't going to happen, but overall that's going to lead to a better outcome. If you do stay disciplined. And clearly within crypto that there's kind of a different level to that. particularly related to bull markets and staying disciplined in those environments. But that's definitely something, kind of learning at my prior firm that I have taken with me.
I love that. All right. What crypto trend is totally overhyped and what is underhyped in your opinion?
I don't know. I mean, probably DeFi is underhyped just because, you have like 10 billion of annualized on-chain revenue, which is massively bigger than every other application layer, like by a significant magnitude. And there's a very clear, massive market where this is a clearly superior technology and way to approach that. So generally, I'd probably say like DeFi. Like I've kind of felt like DeFi has been unloved for a while. It's maybe a little less unloved than it was a year ago, but like on a relative basis, probably still is, underappreciated or underrated, maybe to use your word. What's overrated? I don't know, whatever the current thing is.
What is the current thing?
The current thing right now is probably AI. And I think it's a caveat though. Like, I think anytime you get these things that end up being like really hyped up, there's a bunch of it that gets really hyped up that ends up being basically crap or going to zero, right? But then there's like some core of it that actually ends up being like really, really fundamental and game changing. So I think it's tough to categorize all of that together. But yeah, like what's the current thing right now? Probably, yeah, hating Ethereum, AI related stuff, meme coins. And again, I think it's more nuanced, but those all seem to be a bit more popular at the moment.
I like it. All right. What is one piece of advice you would give you if you could give to your younger self before starting your firm? What would that piece of advice be?
It's a good question. So I think probably from when we started our first fund, from like a fundraising perspective, understanding who is your target audience. Probably one of the mistakes that we made as a first time fund. I kind of come from like the big institutional world, right? So that's kind of what I was used to. And when you're a small first time crypto fund, that is not typically your audience. And that was kind of a learning that if I could go back and talk to myself, probably could have saved myself a little time there. I think from like an investment perspective, it's just kind of what I was describing before, like stay disciplined. You don't need to be everything to everyone or do every deal. Like just understand like what is your edge and just go exploit the crap out of it. And that's where you have the most success. Those would probably be the two main things off the top of my head.
I love that. All right, Brooke, thank you. This was amazing. I appreciate you taking the time. Where can people find you and learn more about Hut?
So our website's hutcapital.com. As you mentioned earlier, shameless plug, we do have our own podcast.
It's great.
Which I'm personally a big fan of, called Inside the Hut, which you can find on Spotify and Apple Podcasts. You can follow Hut Capital on Twitter at HutCap. And yeah, I think those are the main ways to find us.
Amazing. Brooke, thank you so much, man. Appreciate it. And I will talk to you soon.
Yeah, it's a lot of fun. Thanks so much, Andrew.